Okay. Well, hello, everyone. Thank you for joining us today. This is a session by a National Aging in Place member, Sue Haviland, as part of our educational series of Aging in Place Education by NAIPC members. So Sue today is going to be talking about reverse mortgages and how aging in place professionals can use this as a estate management tool. So I will go ahead and turn it over to Sue. Thank you so much for joining us today. I went ahead and enabled your screen share. So the floor is yours. For anyone that has any questions, if you're watching this live on YouTube or the recorded version, you can email me at tara@taraballman.com. That's TARABALLMAN.com. And I'll be sure that Sue will answer your questions after the presentation, or if it's the recorded version, I will forward those along to her. So thank you, Sue, for joining us today.
Thank you very much. Can you see my screen?
No, not yet.
All right. Let's see if we can get that to work. Okay. There you go. Can you see it now?
Yes, now we can see it. Perfect.
Perfect. Okay. And we will go ahead and get this started. Thank you, everyone, for attending this presentation today. And thank you to the National Aging in Place Council for inviting me. Thank you so much, Tara. We're going to talk today about reverse mortgages for aging in place professionals. And what this will be is just a high-level overview of the structure of the reverse mortgage, some important components that you need to be aware of, and then how you might be able to think about the reverse mortgage in your practices and how you might be able to recommend this if it's appropriate for some of your clients. Now, of course, the reverse mortgage does have some acronyms, just like every program. So I promise that I will not use an acronym without defining that for you. So let's go ahead and get started. Let's talk about what we're going to cover today. We'll cover what is a reverse mortgage in its most basic definition. We'll cover the uses for today's reverse mortgage, how a reverse mortgage and aging in place concepts can work together. And we're going to probably give you maybe a couple of options that might surprise you. We'll talk about some examples, and then we'll wrap it up with a summary. The reverse mortgage, let's get down to basics. What is a reverse mortgage? In its simplest terms, a reverse mortgage is a loan program that gives homeowners age 62 and over the ability to convert a portion of their home equity into liquidity without incurring a monthly mortgage payment to a lender. That really is its simplest definition: convert a portion of their home equity into liquidity. Borrowers are not required to sell the home, give up title, or take on a new monthly mortgage payment, although they can make a payment if they choose. Payments go from the lender to the borrower rather than from the borrower to the lender, as we typically think of in a traditional loan. There are a variety of ways that the borrower can access the funds, and we're going to talk a little bit more about that in just a bit. Now, the borrower is responsible for prompt payment of annual property taxes, homeowner insurance, flood insurance, homeowner association or condominium fees, maintenance, and any other property requirements. The loan proceeds are first used to satisfy any outstanding mortgages or liens on the property. And for many borrowers, simply paying off that current mortgage and relieving themselves of the obligation to make a monthly payment is a good enough reason to look into a reverse. The loan balance plus any accrued interest does not have to be repaid to the lender until a maturity event occurs. Now, there's one of those reverse mortgage words, a maturity event. That could be something like the homeowner sells the property and moves out, or the last remaining borrower passes away. As you see on the screen, the HECM, or home equity conversion mortgage, is a federally insured reverse mortgage, once again for homeowners age 62 and over. And that is still one of the more popular products that we see today. Now, the very first reverse mortgage was written back in 1961. So for everybody who thinks that this is a brand new product that's new on the scene, yeah, 1961. This mortgage helped a widow remain in her home despite the loss of her husband's income when he had passed away. However, back then, in its infancy stages and without the safeguards we see today, the loan, which began as an act of kindness, was lacking in oversight and protection for both the borrower and the lender. So this now insured pilot program in the 80s was actually signed into law on February 5th, 1988 by President Ronald Reagan. And as we said, the HECM is still among the more popular products, but there are also proprietary products on the market today. They offer solutions for situations where the HECM may not be the best fit for the borrower. And some examples include higher home values or condos that perhaps don't meet FHA guidelines. Now, please keep in mind that not all proprietary products are available in all states, so be sure to check with a reverse mortgage lender if that's something that you're interested in learning a little bit more about. Next, let's move on to the misconceptions. I've chosen 3 here to discuss, and we hear a lot of myths and misconceptions about the reverse mortgage all the time. Even though the reverse mortgage has been in existence for close to 6 decades, I can't believe that every time I say that, but there are still many, many myths and misconceptions that remain, including the 3 that I've selected here. First of all, the home must be debt-free before a client can qualify. Now, you just heard me speak to this a moment ago. Oftentimes, just getting rid of the obligation of that mortgage payment can be reason enough for a borrower to look into a reverse mortgage. So the borrower can indeed have an existing mortgage on the home, but the lien must be paid off prior to or even at closing, which is very typical, using the funds from the reverse mortgage. And even if there's a small shortfall, even if the borrower needs to bring a little bit of money to closing to make that happen, they can. And oftentimes a borrower will decide that that is worth doing in order to relieve themselves of the obligation of that monthly mortgage payment. The second myth or misconception is that the bank owns the home. This is just not the case. The borrower is not asked to exchange title to their home simply for securing a reverse mortgage. This is not a requirement for today's FHA insured mortgages as well as proprietary products. And the last misconception is that the heirs will incur an outstanding mortgage debt. And we hear this one all the time. I've heard this many, many times over the years. We'd love mother and dad to get a reverse mortgage, but we don't want to be saddled with a large debt at the end of the loan. Well, the heirs are not responsible for any outstanding debt incurred on the reverse mortgage. The term non-recourse, which is what reverse mortgages are, the term non-recourse indicates that the lender's only recourse to satisfy the loan is through the sale or refinance of the subject home after a maturity event occurs, right? After a maturity event occurs. And we talked about what a maturity event is, the borrower passing or selling the property and moving away. So the heirs are not responsible, nor are any other assets at risk, even if the home value does not cover the loan balance at the time that the home is sold. The lender can't say, oh, well, we see you have an IRA or some other asset. That just can't happen. The house stands for the loan. There are some important safeguards that are attached to the reverse mortgage. And of course, FHA monitors reverse mortgages closely and consistently updates and improves the product by implementing safeguards that are designed to protect the integrity of the product, as well as keep the best interest of the borrower in mind. Some of these protections include, once again, as we just talked about, the non-recourse feature. There's also a financial assessment process that borrowers undergo, and this is to ensure that they have the proper cash flow and that they can utilize the reverse mortgage as a sustainable long-term option. This is not meant to be a short-term Band-Aid. This is something for the long term. In addition, there are safeguards for non-borrowing spouses. When we have a spouse who is perhaps not yet old enough to be a reverse mortgage borrower, they're not yet 62, there are some possible protections in place for that non-borrowing spouse should the borrower pass away. And HECM regulations and rules, once again, are meant to provide protection and peace of mind for borrowers as part of a responsible retirement planning strategy. So reverse mortgages really are being viewed as part of an overall retirement planning strategy and the use of home equity in retirement. Let's talk about the demographics. I'm sure everyone on this call is familiar with the growing older adult population. And specifically, we can talk about the baby boomers. You see here on the screen that the number of older Americans is projected to increase from 43 million in 2012 to 84 million in 2050 and up to 92 million by the year 2060. This is a growing population. And when we specifically talk about the baby boomers, we're talking about everyone who was born between 1946 and 1964. I've heard a lot of numbers kicked around about the actual size of the baby boomer generation. I settle on, it's about 78 million people. And this generation is so large that it's actually divided into two segments. There are leading edge boomers who were born closer to the beginning, to the early part of the generation. And there are trailing edge boomers who were born more toward the end of the generation. I myself am a trailing edge boomer. The 55 and over age group controls more than 3/4 of American wealth. This is a big group. It's an active group. It's also a group with varying degrees of wealth, but they all share a concern for longevity. Let's take a look at the borrower eligibility and obligations under a reverse mortgage. And we're talking about the HECM specifically now. The borrowers are 62 years of age or older, U.S. citizen or lawful permanent resident. They occupy the property as their primary residence. All reverse mortgages require that the borrower occupy the property as their primary residence. They must receive counseling, third-party counseling. And as we already said, they must maintain property obligations such as homeowner insurance, property taxes, condo and HOA fees, any associated property charges. Let's talk about determining borrowing power, because that's always the question that we get right away. When a homeowner chooses to utilize the reverse mortgage, there's a process. There's a HUD formula that's used to determine the amount of funds that can be accessed from the home equity with a HECM. The factors that are taken into consideration to determine the borrower's available proceeds are the age of the borrower. Once again, remember, minimum age is 62. to be a borrower, the interest rate on the product that the borrower has selected, and the maximum claim amount. Now, there's another reverse mortgage term, the maximum claim amount. We define the maximum claim amount as either the appraised value, the current FHA lending limit, which is $822,375, or the purchase price. Did I say purchase price? Yes, I did. We're going to talk about that in a little bit. It's the lesser of the appraised value, the FHA lending limit, or the purchase price. That is considered the maximum claim amount. These factors go into a HUD formula, and they are used to calculate what we call the principal limit, or the amount of proceeds that the borrower is eligible to receive. Older applicants generally qualify for more or a higher principal limit proceeds, and younger applicants generally qualify for less or lower principal limit proceeds. This is one product where it's better to be older. Next, we're going to touch on some uses for today's reverse mortgage. There are flexible options, payment options to suit the borrower's needs. The borrower really does dictate how they want to take the funds on a reverse mortgage. For adjustable rate products, there are a lot of flexible solutions. The borrower can take a line of credit where they can withdraw the funds as needed to use for any purpose. There are tenure payments. Think of tenure like a professor, not 10-year, but tenure, monthly payments that run for the life of the loan, no matter how long the borrower lives in the property. They could take a term payment, monthly payments for a set period. Let's say, for example, the borrower says, I'd like to receive my payments for 10 years. Okay, terrific. We can set that up. They could also take a lump sum, or they can take a combination of any of these options. They can take a small lump sum. Let's say that they want to make some modifications to their home. They might take a lump sum, and they might combine that with a term or tenure payment, and then also establish a small line of credit to be available for future needs. Now, those are the options available on the adjustable rate products. The fixed rate product has only one option, and that is a lump sum that is taken at closing. Now, there could be good reason for using the fixed rate product. Perhaps the borrower has a larger mortgage balance that they're wanting to pay off, or there's another option that we're going to talk a little bit more about later on. The other thing that the borrower can do, which I find most interesting, is on the adjustable rate products, they can change their mind. If they find that the line of credit isn't working for them, all they have to do is call the servicing department and request that their funds be recalculated. Perhaps they'd like to turn that into a tenure or term payment. And for a small fee, they can do that. The funds are theirs to use in any way they would like. The many uses of a reverse mortgage. Now, we've already touched on paying off the current mortgage and what I like to call retiring that mortgage payment. But remember, they always can make a mortgage payment if they choose to. The borrower just does not have an obligation. They could also establish, as we just said in the previous slide, a line of credit for future needs. This is a wonderful financial planning tool, and it does a couple of things. It can be a safety net for the future, and it also negates the need to liquidate other assets and other investment accounts. A monthly tenure or term plan can help with monthly budgeting needs or other things that we're going to talk about in just a moment. And this brings with it financial security for estate planning. And perhaps we have a borrower who's still working full-time because they needed to make that mortgage payment. Well, think about this. Now they might be able to only work part-time, or they may be able to retire completely and truly enjoy their retirement. They also may, as I said in the previous slide, may want to take a lump sum to make home modifications to age in place. Think about all of the home modifications that can be made for someone who wants to stay in their home over the long term. They can make those modifications and have it that their home is such that they truly can age in place. I'm going to back up and cover a couple of more items on here. I also talk about it for the monthly tenure or term payments. In addition to helping with monthly budgeting, they might use that to cover the rising cost of healthcare. We know that healthcare costs rise constantly, and that can be a big drain on a budget. So think about that, cover the rising cost of healthcare. In addition, the rate of divorce among older adults is rising, and the reverse mortgage can be an excellent solution when one party wants to stay in the home after the divorce and perhaps needs to buy out the other party. So keep that in mind. If someone is in a divorce situation as an older adult, they might want to think about utilizing the reverse mortgage if one party does want to remain in the home. Reverse mortgages and aging in place concepts. Let's talk for a moment about someone who says, I want to stay in my current home. My current home fits my needs overall, and this is where I want to age in place. They could, as we said, take a monthly tenure or term plan for the reverse mortgage to supplement monthly cash flow and cover additional needs. The line of credit can provide funds for unexpected expenses, such as home repairs. And it's a safety net for future needs. The line of credit also carries with it a growth feature. So that makes it another excellent option for a safety net for future needs. You could just establish the line of credit and allow it to grow over time and have those funds available if they are needed. Perhaps someone wants to access their line of credit just to travel or enjoy vacation. Or they want to take a lump sum. Remember, I said there were a couple of other really good reasons to take a lump sum. Perhaps someone wants to take a lump sum out using their reverse mortgage. They want to remain in their home as their primary residence, but they'd like to purchase a vacation home. Let's continue to talk about those who want to stay in their current home. Maybe they want to have in-home health care. A tenure or term payment could be used to provide those funds to pay for someone who wants to have home care come into the home. Also, if you're a home care company and you're listening to this today, think about if you have a client who might be running out of funds, might this be a solution? If they're very happy with the services, this might be just one use that they might have for reverse mortgage funds. And we talked about home modifications to age in place, making the home such that the borrower can stay there over the long term. Covering that rising cost of healthcare. We know that healthcare costs can truly be significant. And what about safety considerations? I talk about certified aging in place specialist contractors. I don't know if we have any of those on the call today, but when you're considering home renovations, certainly safety considerations are among those. I am the president of StepSmart, which is a fall prevention nonprofit located here in Southwest Florida, where I live. And we do presentations to communities and other groups about the importance of fall prevention. And this is one of the biggest safety considerations for someone who wants to stay in their home. Is their home safe over the long term? And I also like to talk about technology. Technology continues to advance to allow older adults to stay in their home, stay in communication with family members, stay connected. And I just mentioned one thing, I just mentioned the wearables, but there are lots of technological advances, perhaps some of you on this call today are familiar with. Now, what about if a client says, my current home may not be the best option for me to age in place. What options does the older adult have? They could sell their current home and rent. They could sell their current home and move in with family. They could sell their current home and move to an assisted living community. Any one of these options might be the right one for that particular individual. But there might be one that we haven't thought of. What about a reverse for purchase? A reverse for purchase allows adults age 62 and older to purchase a new principal residence using loan proceeds from the reverse mortgage, along with a one-time equity contribution from the borrower. And you see that phrase, one-time equity contribution. If you're talking about a traditional loan, you would call that a down payment. In the reverse world, we call that a contribution. So just think of it in those terms. And this can open up an entirely new conversation. The reverse for purchase program is a great option for clients to buy a new home that will be their primary residence without using up all of their cash or taking out a traditional mortgage, right? Because they may not want a mortgage payment going into their retirement years. Although, oddly enough, traditional mortgages are still the financing vehicle of choice. So we're hoping that more and more older adults will look at the reverse for purchase as a good option. Buyers can use a reverse mortgage to finance part of that purchase price, and it significantly reduces the amount of out-of-pocket funds that they must bring to the table so they can preserve those other assets and investments. Buyers can save more of their proceeds from the sale of their current homes. And that's typically the way we see a reverse for purchase structured, is that the buyers will sell their current home, the home that no longer meets their needs. We call that the departure residence. And then they will take the proceeds and apply that to the reverse for purchase. And at closing, they only bring the difference between the reverse mortgage proceeds and the sales price. So think of that in terms of a traditional mortgage and a traditional purchase. And with a traditional purchase, you have the sales price, and then you have the mortgage, and what remains is the down payment. Once again, we call that an investment. There are no monthly required mortgage payments, and the loan does not need to be replaced or repaid, unless the borrower sells the home. The home is no longer the primary residence of at least one borrower, at least one, or the borrower does not meet obligations such as tax, insurance, or property maintenance. Why would a borrower want to look at a reverse for purchase? They might want to purchase a primary residence that will better meet their needs. They might want to downsize. They might want to upsize. We call this downsizing, but upgrading. They might want to upsize. Don't only think that all older adult buyers want to downsize. Sometimes they actually want to purchase a larger home, maybe that has better amenities and upgrades, because this can be used to purchase new construction as well. Perhaps they want one-level living or a maintenance-free exterior. Once again, there's that technology. Technology plays into a lot of these decisions. They might want to move closer to family. They might want to move closer to public transportation. And I saw on the Aging in Place website, there was an article about how to get around when you're no longer driving. This is a really big consideration too. Over the long term, where do I want to live? If I need to have access to public transportation, that's something I need to consider. And then social, but we don't want people to be isolated. And if I can't drive and I can't get somewhere, then I could become isolated. And perhaps they want to move to a community where there are amenities in close proximity, so they don't have to drive long distances to get to the activities that they want to participate in. So a reverse for purchase offers non-recourse lending with no personal liability. As we said, the lender's only recourse is the home at the time it is sold, the value of the home at the time it is sold. No required monthly mortgage payments. And of course, borrower must keep real estate taxes, homeowners, and other property charges current at all times. And it gives increased buying power for older adults. And I'm going to give you a couple of examples that speak specifically to that. But real estate professionals and financial professionals really should understand the reverse for purchase and how it can be used as part of an overall plan. And it really is all about lifestyle. Once again, perhaps the borrower wants to be close to family and friends. They want to be able to travel. Instead of taking care of a home, they want to be able to travel and have an active lifestyle. So perhaps a home with less maintenance and less yard work. Maybe they want to stop working or go part-time and maybe volunteer, or maybe move into an entirely new endeavor. Maybe they want to work in a new business. Energy efficient housing and maintenance-free housing is also something that we see. Let's take just a quick moment to talk about the property eligibility in a reverse for purchase. The property being purchased must meet Federal Housing Administration, FHA, property standards and flood requirements, and it must be one of the following property types. It can be a single family home, a 2 to 4 unit property. Wait a minute, Sue, did you just say a 2 to 4 unit property? Yes, I did. What about a borrower who purchases a 2 to 4 unit property, lives in 1 unit as their primary residence, of course, and rents out the remaining units for additional income? Can also be used for HUD and FHA approved condominiums and manufactured homes that meet FHA standards. Let's take a look at a couple of examples and options of how the reverse for purchase might work. And once again, these are just examples. There's lots of variables that go into these calculations. So I'm just showing some very general examples today. Let's talk for a moment about John. John is 73 and widowed. His children are concerned about his living alone in a large, older home in a rural area so far from where they live. They've talked with him about moving in with them, but he insists that he would rather have his own place. He understands their concerns, but has always been independent and tries to stay active. But he does admit the stairs and the maintenance required on an older home are a bit much. He learns that he could purchase a smaller, newer home that is closer to town and even has public transportation nearby. There's a community college in the town where he can take classes. This new home only has 1 floor and has features that will allow him to age in place, such as a no threshold entryway and plenty of light. His daughter admits to being concerned about him falling. A reverse for purchase will allow John to buy this new home without the obligation to take on a monthly mortgage payment, and he'll be able to utilize just the proceeds from the sale of his current home as the required investment. And I want to stop here and talk about something that I mentioned as part of John's story. I mentioned community colleges, and I get this question a lot, so I want to just take a moment to talk about this. If you're looking for a wonderful way to reach out to your local community as a marketing strategy, talk to your local community college, partner with other aging in place professionals and put together some classes that you can teach at the community college. A lot of colleges and universities actually offer lifelong learning programs, and they will welcome your expertise. So just think about that. I get a lot of questions about that, and I think it's a wonderful idea if that's something that you would be interested in. And here is our example for John. John is going to purchase a new home at $400,000. And remember, I said we use the age, the purchase price, the current interest rate, et cetera. That all goes into a HUD formula. So this lets us know that John would be eligible for reverse mortgage proceeds in the amount of $205,000, which means he only needs to bring $195,000 to closing, right? 205 plus 195 gives us our purchase price of $400,000. Now, John has already sold his current home and he netted $210,000 from the sale of that previous home. We call that his departure residence. So John can purchase this new home. He will not have the obligation of a monthly mortgage payment, and he can have $15,000 cash remaining from the proceeds from his previous home, right? He had $210,000 in proceeds, but he only needed to use $195,000. So John can now age in place in a home that better meets his needs. He doesn't have to be concerned about driving. There's public transportation nearby, and there are activities that he is going to be interested in. So this could be a wonderful solution for John. Our next example is Robert and Marie. Robert and Marie are both 68 years old. They no longer wish to take care of the large yard and large home where they raised their 3 children. Robert still loves to play golf, and Marie enjoys volunteering at the local elementary school and would like to travel more now that they're both retired. Robert has his eye on a community where there are several golf courses nearby, but Marie is not comfortable with taking on a new mortgage payment or taking extra funds from their investment accounts in order to purchase a home. Limiting themselves to the amount of cash they will net from the current home will not get them the home that they want. They're fortunate to be working with a real estate professional who has heard about the reverse for purchase product. Utilizing the reverse for purchase, they can downsize to the newly built smaller home that they want, of course, with the upgraded appliances and oversized patio that Marie likes, without the obligation of a monthly mortgage payment. And they will also have funds left over from the sale of their current home. So this is an example of downsizing, but upgrading. And you see on the screen that the borrower must live in the property as the primary residence and keep real estate taxes and insurance payments current. So for Robert and Marie, we have a purchase price of $650,000, which when we put all of their information into the HUD formula, that gives us reverse mortgage proceeds of $320,000. The cash investment they need to make is $330,000, right? Because 320 plus 330 gives us our 650. But the proceeds from the sale of their current home is $400,000. Now, if they were going to go the traditional route, they would purchase the home for $650,000, put down $400,000, and still have to take out a regular or traditional mortgage for $250,000 and incur a mortgage payment as they're going into their retirement years, right? We said they're both retired. So in this way, they can utilize the reverse for purchase. They can purchase their new home and have $70,000 cash remaining from the proceeds from their other home, their previous home that was already sold. They netted $400,000 and they only need to invest $330,000 to get this new home utilizing the reverse for purchase. And just as some final thoughts, there are many ways that the reverse mortgage can open up a new conversation and play a key role in a client's aging in place plan. Whether remaining in the current residence or moving to a new home, the reverse mortgage can offer solutions to fit the needs of today's older adult. And I want to thank everyone for their kind attention today. And Tara, do we have any questions?
I did not see any questions come in through the email or the chat box. If anyone has questions, you can still email them over to tara@taraballman.com. And while we're waiting, Sue, I did want to ask you a question about, let's say someone had a reverse mortgage back in 2008, and I don't know what the real estate market is like in Florida, but here in California, it's booming and things are flying off the market and prices again are skyrocketing. So let's say the value has increased. Are people still able to refinance their reverse mortgages?
They absolutely are. And thank you for asking that question. Yeah, you can do a refinance. We call that a HECM to HECM. And it is possible for the borrower to do a refinance. There are some criteria that they need to meet to be able to do that. Once again, we always want to make sure that it makes sense for the borrower and that it's a sustainable solution. But yes, it's entirely possible.
Fantastic. Well, thank you. I did not see any questions come in. So thank you everyone who was joining us today. If you have any questions, you can email me and I will get those over to Sue and we'll be happy to answer your question today or anytime in the future. So thank you, Sue, so much for all of your knowledge and for sharing that with us today.
My pleasure. Thank you.
Thanks.